We're taking a look at soybeans, May, or actually March and November soybeans, asking the question, how would you invest in soybeans? If there is inflation and you want to be an investor, not a short-term trader. I'm a short-term trader. I trade algorithms and I use margin. And so what if you wanted to trade a long-term trade in soybeans? Maybe you think soybeans is going to 20. This is the current front month March soybeans futures at $13.76 and a quarter cents. This is November 21 soybeans, $13.63 and 1/4. Lower price out in November. The market anticipates that future prices in November will be lower by over $2 a bushel. So if you are contrarian, if you anticipate higher prices, the opportunity is greater to invest in November soybeans. I'm not suggesting that you should, but if you're a long-term investor and you don't like to take short-term trades like I do, you would maybe consider trading soybeans through November, and with a potential price move higher, somewhere between the price where it is now, $13 to $15, and even high as $20 if inflation goes out of control this year, and we get a massive commodity bull market. What would your risk be? How would you set up this trade? This is a theoretical discussion on how to set up this trade for long-term trading in commodity bull markets. How would you see this trade? So if you take the price of soybeans, $11.63 and a quarter, what is the value? What is the value? If you were going to buy soybeans the way you would stocks, what was the value of that? Well, soybeans comes in contract sizes. So this is $11.63 and a quarter cents. And so if you multiply that times 5,000, because this is when you buy a futures contract, you get a fixed value of 5,000 bushels. Now you can trade a smaller contract value. The mini soybeans is 1,000 bushels. So you'd multiply it by 1,000. So if you were trading this on the mini basis, it would be $11,630 roughly. So a mini contract of soybeans would be $11,630 approximately. That's the value of the mini soybeans contract in November right now, and you would lose all your money if soybeans went to zero. So I don't believe that soybeans is going to zero, but if you were to invest in this with a potential for a higher move, if you anticipate higher prices in soybeans, your $11,630 would cover you, so you're not trading with margin. If you have the full value of the contract you purchased in your account, you're not using margin at all. So if you hold that contract through the first notice day with an anticipation of higher prices, you would gain $1,000 for every dollar move higher in soybeans. So if the soybeans, the price of soybeans went to 12, and you got in at 12, you'd be buying $12,000 worth of soybeans. If soybeans went to 20, the value of that contract would be worth $20,000. The gain would be $8,000 in soybeans on the mini soybeans contract. Now, just to give you this example, say on the regular soybeans contract, that would be $40,000. So in futures, we use margin. What is the margin on mini soybeans? The margin on mini soybeans is $605. So for example, if you bought soybeans here at $11.63 and a quarter in November, and you paid you deposited the minimum margin $600, and soybeans went to 20, your profit would be over $8,000, and so that would be compared to an $8,000 profit compared to this margin, this minimum margin in futures. This is where you get in trouble in futures. If you don't have enough margin, then you can't withstand drawdowns. So what if soybeans drops? What if soybeans comes all the way back here and tests the $10 level? Then you will be down $2,000. If you buy this at 12 and it drops to 10, your profit and loss will be minus $2,000. If this rolls over all the way back to $8, you'll be down minus $4,000. That's on the mini contract. So if you only deposited $605 to take this trade, your account will go at a deficit because you're trading an $11,630 contract on the minis and 5 times that amount on the regular size feature. So it'd be a $58,000 contract on regular soybeans. So this is a discussion on margin. You can use margin more effectively if you have a good strategy to trade short term. You can manage your risk if the trade duration is low, if you have stops. But if you're investing and willing to hold through big swings in the market, you don't need to use this much margin. You would take the full contract value 11,630 and consider the risk, the maximum loss. If you said all the way back to $8, okay, you're willing to risk 4,000 to potentially make 8,000. If it goes to 20, then you have to consider depositing at least 4,000 plus the margin required, $5,000, or about 2 to 1. You're basically starting the trade in 2 to 1 ratio of margin versus using an aggressive $605 margin. This is okay if you know how to manage this with a short-term strategy, but doing this on a long-term basis, don't do that with the minimum amount of margin. This is where most futures traders get in trouble. They use too much margin, they don't manage the risk, and so if you have a long-term perspective on something, you typically have to have bigger stops, and you have to trade smaller contracts if you're not capitalized. This is just a theoretical discussion on how to invest in commodities, how to invest in a long-term bull market. If you wanted to buy one mini soybeans at 12, stop loss at 8, profit target 20, that would be a way you could do it.